The Fed, Jerome Powell. Oh, holy smokers, this ain't no jokers. That is all the talk here today, folks. Hope you enjoy this meme a friend sent me here. Oh, man, high inflation, bank failures. Why don't we go from both? We have a lot to get into in this video here today, folks. I'm going to take you through some opportunities I see in the market. I'm actually going to take you through a watch list that I have of stocks that I'm looking to potentially add to or add for the first time ever in the second quarter of this year, which is approaching very quickly here. At first, I want to talk about what actually tanked the market. Something tanked the market in the last 30 minutes to an hour of trading, and I want to take you through that. And it actually is not Jerome Powell and the Fed. We're going to talk about what he said. He said some very important things that I thought are worth addressing in today's video so you can understand kind of where this market's moving, where stocks are moving, everything like that. But actually something that tanked the market had absolutely nothing to actually do with Jerome Powell and the Fed. And I want to take you through that. So hope you guys enjoy this video. As always, thank you every single person that subscribed to the channel. I appreciate each and every one of you, and I hope you enjoy the content I obviously produce daily for you guys. Okay. Alrighty. So once again, I love that. I love that meme there. Okay. So here we go. This is around the time Jerome Powell started talking. Press conference, 25 basis point move, the whole dealio there, right? So it all was going great. It was all going great, right? And Dow was up to 32.7. It was even over 32.7, right? And then suddenly we get about a 400-point drop in the Dow Jones Industrial Average. And I mean, it happened quick, right? In a matter of 10, 15 minutes, we get the Dow to drop 400 points. And then by the end of trading, we got the Dow to drop another 300 points or so, all to finish at about 32,000 even, when we were at 32.7 plus, right? So we got a 700-point drop in this market in a matter of, let's call it an hour, roughly, right? Now, when you see a move like that, you need to ask yourself something. And this is a very important question. You need to look and you need to say, did the market just drop for a fundamental reason? Did it drop because of a commentary reason, or did it drop because of an algo-related reason, something mechanics of the market? And in order to kind of understand that, you've got to dig a little deeper here, and you've got to look at all those potential possibilities, okay? So let me take you a step further into this. Look at other indexes or other stocks. Did they have a similar move? Okay. So I just pulled up a whole host of random companies here that are in totally different industries than each other, right? PayPal, Uber, Snowflake, Netflix, Tesla, all those companies in very different sectors, industries, like what their business models are, everything, okay? And all of those stocks did the same exact thing the Dow Jones Industrial Average did, despite none of those stocks even being in the Dow Jones Industrial Average. So this means whatever happened completely tanked everything across the market when it comes to equities, at least. But then you need to take it further and you say, did everything tank, or was it only equities, right? You look at something like silver. Silver had a great day. So silver did not participate in this tanking action that went on. So something specifically stock related, right? But then you look at WTI, crude oil, and that had a pretty similar pricing action to the Dow Jones Industrial Average and stocks in general, right? And so then you have to ask yourself, is it recession fear? Is it algo sell-off? What happened here, okay? And so in regards to this, it was not Jerome Powell. It was not the Fed. It was Janet Yellen, okay? Janet Yellen is the one that tanked this market. She used to have the position that Jerome Powell does here today, okay? And she's now the Treasury Secretary, still a very important position, right? So Janet Yellen said she wasn't considering ways to guarantee all bank deposits at a Senate hearing today, right? That was going on pretty much simultaneously with Jerome Powell's press conference. This is not something that we have looked at. Now, this is very concerning to the market, and it caused a massive algo-related and potentially even, let's call it a human-related sell-off in the market in the last 30 minutes to an hour of trading here today. And the reason being is they're talking about, all deposits are guaranteed, we're going to make this right, all this stuff, right? But now if you're talking about you're not really looking for ways to expand on this, right? If you're not really looking to boost FDIC insurance past 250, then it creates uncertainty in the market. So now at this point in time, people are a little confused. And the market's very confused. They're like, well, are my deposits okay if I have more than $250,000, or are they not okay? This created confusion. Whether this was, planned confusion or unplanned confusion, it caused confusion in the market. It caused uncertainty. And what do I always tell you guys is the number one thing that the market hates more than anything else, it is uncertainty. And this, what Janet Yellen happened there, okay, when she was questioned, the way she answered that, it caused for uncertainty. about what is actually guaranteed when you deposit at the bank. Is it 250? Is it 500,000? Is it a million? Is it 10 million? Like, what's the number, right? So that was problematic for the banking system, for everybody to hear that and cause confusion and uncertainty at a time period when that shouldn't have been happening, right? But this extremely important here, okay? Yellen said, many of these banks felt very skittish about their potential to suffer runs as well. We can see that banks across the country are shoring up their liquidity. They are very worried about contagion from the troubles of Silicon Valley Bank, SVB Bank, and Signature Bank. And the steps we took were designed to improve the confidence of all depositors that they're safe in banks. But once again, if you're not really having these discussions about upping, let's say, FDIC insurance to, let's just say, unlimited money, right? Or to 500,000 or a million or whatever the new number is, it causes uncertainty for folks. Folks say, you're only saying 250, right? And we got to be honest, Wall Street is made up of a lot of people that have a whole lot more than 250 in a bank account, right? So this is very, very troubling. This was, the way Yellen kind of answered that question, it just wasn't good. It was not a good look, and it added to uncertainty in the financial system, okay? That's why the market actually tanked. Now let's talk about the Fed, Jerome Powell, and some of the important things that came out of that. Then we'll get to stocks, talking more about the markets, opportunities out there, and things like that, okay? So Federal Reserve Chair Jerome Powell said Fed officials don't see rate cuts this year. That definitely threw some cold water on the market as well, right? That was not the main culprit on why the market dropped so much. I think it was more the Yellen uncertainty, but this definitely kind of started to bring the market down already, right? Because at the end of the day, a lot of people believed that the Fed might be closer to cutting rates soon, okay? And so him coming out and saying that, my opinion on this is, of course he's going to say that. You think he's going to come out and say, yeah, we're planning on cutting rates next month or 3 months from now, 6 months from now? No, of course not. Because if he comes out and says that, do you know what's going to happen with the market? Do you know what's going to happen with stocks? They're going to rocket ship. That's exactly what he's not trying to have happen right now. He doesn't want the market to skyrocket right now. He doesn't want financial conditions to ease. He can't have that right now. We're still in the inflation fight. And until we've won that war, we can't rocket this market, right? And so the Fed's going to do everything in their power to keep the market at bay right now, to not have that baby skyrocket in any way. And so, in my opinion, that's exactly what he should have said. The fact that this threw cold water on the market, I'm kind of like, there's no way Jay Powell is going to come out today and say, yeah, we're thinking about cutting soon. Because you know what, the Dow would have been up 900 points, 1,000 points today. You know what I mean? Like this, he can't have that happen right now, okay? Not right now. Down the road, okay. But not right now. Not when you're still in the inflation fight, which in 2023 is still fighting inflation. Has become less of a problem, but it's still the fight, right? Just in, Fed Chair Jerome Powell says, the process of getting inflation down has a long way to go. It will be bumpy. Exactly. That's exactly what he wants to say. You know the mistakes he made last time he had a press conference. He gave the interpretation of disinflationary process of, we're starting to win this fight. We haven't won yet. And so at the end of the day, he made sure he didn't have any of that in this one, okay? And he basically just said, we got a long way to go. It's going to be bumpy, all these sorts of things. That's exactly what you should expect from Jerome Powell. He does not want this market to go up right now. He does not want financial conditions to ease, okay? Now, in reality, we know inflation has started to make great strides, specifically over the last number of months, right? And this is great. Great news. And then we'll show up in the government numbers that will show up in the CPI over the next several months, right? But the last thing Jerome Powell wants is any financial conditions to ease, a market to skyrocket, anything like that. He does not want to risk commodities going back up in a meaningful way. He wants to still have the question out there about recession, because at the end of the day, he does not want to see inflation come up more. Because if inflation starts to come up more, then you got to drag on interest rate hikes longer, and you're causing more pain for a longer amount of time. So just getting rid of all this pain this year, right? It's like you could get rid of all this pain this year, or you could drag this on into 2024, 2025. Why don't we just drag it on forever, right? And so that's the mistake he's not trying to make in this situation. That's great to see, but at the end of the day, it's got to show up in all the government numbers month after month after month after month for several months in a row. But this is where things get super interesting, okay, is what the market's expecting. So the market is expecting rate cuts this year, regardless of what Jerome Powell says, okay? So basically, starting around June, the market is expecting the Fed to start slowly cutting rates. And then for the rest of 2023, they're actually expecting the Fed to continue to cut rates. That's interesting. I think there's definitely a possibility if we see CPI start to come, let's say in the threes this summer, which I think is very, very possible to see CPIs in the threes this summer. If we start to see that, I think rate cuts are definitely a realistic possibility if we saw something like that. And so I will agree with the market. It's definitely a possibility. If inflation stays, let's say 5, 6s, no, we're not getting any rate cuts. But I can tell you, if we go under 4 and we start touching 3s this summer, yeah, the Fed will start cutting rates. Because they'll look at any economic indicators that are negative at that time, that are bad, and they'll use that as a reason to cut rates. Because we know the Fed really doesn't want to keep rates up. They have to keep rates up because of the inflationary fight, right? But they don't really want that, right? Ross Gerber tweeted out this. He says, and Powell kills a market rally as he continues to prove how clueless he is about the current economic conditions, okay? And this is just kind of laughable to me, just completely laughable. Because in all due respect, okay, we have to slay the dragon that is inflation. I mean, that's the bottom line with this, right? I understand everybody gets impatient. They all want the market to skyrocket in the short term. Well, at least the longs do. The bears certainly don't. But the longs do, or some longs do, right? To my stance on that, I'd rather buy a lot of stocks for cheaper for longer. In my personal opinion, we don't have to skyrocket this baby right now. I'm not retiring tomorrow, I can tell you that much. So I'm perfectly fine. And for anybody that's not retired that's watching this video right now, right, and you have an income, you shouldn't want the market to skyrocket right now because you should be looking to add stocks every week or at least a couple times a month, right? But here's the deal, Ross Gerber. We get the worst consumer confidence ever in 2022. Ever. Worse than the Great Financial Crisis. Worse than Rona. Worse than even in the 1970s when inflation was sky high, right? Worse than after the tech bubble. Think about this for a moment. And so at the end of the day, the state of the economy has been hurt so bad because of inflation specifically. And consumers have been absolutely wrecked because of inflation. And so until we get that beast defeated, what do you want the Fed to do? To start cutting rates when we haven't defeated inflation yet? We've shown a lot of promise there, but we got to get this baby done. We got to get it finished. We got to get the dragon slayed. 80% of the dragon slayed does not count. 70% of the dragon slayed does not count. We got to get 100%, baby. Okay? I mean, you look at this, right? This is real wages, right? And basically, the collapse we had in real wages from 2020 to 2022, right, is the worst we've ever seen. That's a disaster, okay? This is why consumers felt far worse recently, right, in 2022 than they felt even in the Great Financial Crisis. Because in the Great Financial Crisis, remember, even if you got, let's say, a 10% unemployment rate, 9, 10%, whatever we had in the Great Financial Crisis, remember, that still means most people have jobs. And most people had jobs, and you had goods, services, whatever, actually fairly cheap. I remember paying $1 something a gallon for gas in 2009. I remember that. I had an old car that got about 8 miles to a gallon of gas back in 2009. And so I paid heavy attention to gas prices. And I remember going to AM/PM or wherever and paying $1 and some change for a gallon of gas in Arizona, okay? Arizona right now has gas prices of, probably $4 or so, roughly, okay? So at the end of the day, what matters most is what most people are feeling out there, right? And so when you saw wages collapse, the only time we've seen real wages collapse to that extent in a matter of a couple year span was in 1979 through 1981. You saw a very similar phenomenon where real wages absolutely tanked, right? And consumers were in a really, really bad place right here. And by the way, that was right around the same time that consumer confidence was very, very low at that particular time, okay? This is one of the most important charts that is, in my opinion, kind of hidden, that shouldn't be hidden, because this is going to tell you how the economy is actually doing, how the average person is actually doing. Keep an eye on this chart forever into the future, okay? And I hope you got some good value out of just this chart here. Trust me. Keep an eye on this one always in the future, and you'll know how the real economy is doing. This is going to show you how the real economy is doing. And when things are getting ugly, that's going to tell you the real economy, despite what the politicians tell you, what the Fed tells you, whatever, is not in a good place, okay? The good news is, by the way, with real wages, we have bottomed out recently, and we're starting to uptrend again. We got a long way to go with that baby, okay? Jerome Powell said he considered pausing rate hikes in the days running up to the meeting. Now, that I thought was an impactful thing for the market in general, the fact that they're at least considering that, and that likely shows that the Fed's done. That's my personal opinion. The Fed's done now. They are either going to keep rates the same or they're going to cut rates from this point on now at this point in time, okay? The fact that they're already thinking about pausing, That's basically all I need to know in regards to that, okay? And, if you put all the puzzle pieces together, that's what makes sense, man. That's what makes sense now at this point in time, okay? This was the last hurrah, 25 basis point kind of move here, right? Now, if you saw the regional banks, right, those babies tanked off a cliff right in the last hour or so of trading, right? But that was, once again, that's a combo of the Fed and Yellen, right? Another raise hurts the regional banks even more. They already had a lot of problems, right? You raise rates a little more, it's going to hurt these regional banks even more, right? And then the Yellen uncertainty also certainly hurt these regional bank players. And so we'll see what the aftermath is of that whole situation there, but it's not good, okay? I can tell you that. It's not good. Look at the bear troll that keeps on trolling. This is just amazing, okay? So many bears are so mad at this stock, and they keep trying to bet against it. They keep trying to short it. They keep trying to buy put options against it, and they keep losing again and again and again. And I'm like, what for, man? What for? Y'all are just gambling your money away. Like, holy smokers, this ain't no dang jokers. I don't get it. I mean, they keep trying to do it again and again and again. I think when they all finally give up, when all of them finally give up on trying to short this baby and buy put options, I think that's will be the moment that NVIDIA starts actually to maybe pull back at least a little bit, right? But this stock just continues to roar, even on today's day with the Dow Jones Industrial Average down 500 plus points. NVIDIA stock was still up over 1% today. Incredible. NASDAQ was down. Almost all the other big tech stocks were down, and their NVIDIA was up again today. It's the troll of trolls when it comes to trolling bears out there, right? Now, something interesting also happened, and this is very meaningful. The Fed's decision could keep mortgage rates from marching higher. The Federal Reserve's Wednesday statement could help mortgage rates basically go lower, right? The increase was a dovish hike, Mortgage Bankers Association chief economist Mike Frantoni said. The commentary and economic projections suggest we may be at or near peak Fed funds rate cycle 100%. The FOMC statement supports the trade group's view that mortgage rates will fall throughout the year. The trade group's March forecast calls for an average 30-year fixed mortgage rate to be at 5.3% in the fourth quarter, down from the expected 6.4% in the first quarter. Now, I've been talking a lot about, if you want to talk about the economy, and you want to talk about a chance the economy gets hurt really bad, it's if the home builders have all their backlogs dry up this year and they don't have new orders coming in for 2024. We need to bottom out housing in relation to demand as soon as possible, specifically for new builds, okay? And so if you're talking about a lower mortgage rate environment and things just get better and better here, then you can give these home builders a fighting chance, which in my opinion, the best thing to ever happen in the U.S. economy, and I say this time and time again, is a new home is built. Because each time a new home is built, it creates immense amounts of jobs. The economic activity that just comes from one home being built, just a 2,000 square foot home, it's enormous. The amount of companies that make money off that, the amount of employees that make money off that, it's incredible, the direct and indirect jobs, just one house being built, one apartment complex being built. It's enormous, okay? And so nonetheless, this is good news, okay? This is good news for if you want hopes of, let's call it a softer landing for the economy here. I think rocket stock could be an interesting play to maybe dollar cost average into in the back half of 2023. There's a stock that's been anywhere from $6 to $8 here over the last number of months. It's been absolutely devastated. Why has it been absolutely devastated? Well, I can show you this. This is from Yarndini. You guys know I love Yarndini for especially a lot of their different charts and whatnot, right? They go back decades. If you haven't seen this, folks, this is shocking. Mortgage applications have been the lowest recently that we've seen since the early 1990s. Since the early 1990s. This basically means there's no demand for mortgages right now, okay? I can tell you that's not going to continue like that forever. We're likely in a bottoming out process as we speak when it comes to mortgage applications right now. If you know a company like Rocket, they make a ton of money off of mortgage refinances, all that whole dealio, okay? And so this is something I'm looking at and I'm saying this is bottomish activity we got going on here. And if anything, I'm expecting 2023 to be the bottom and we're gonna start moving up when it comes to mortgage applications here, okay? If we pull up this, refinancing matters in a significant way. Refinancing all the way the lowest in 2+ decades. 2+ decades. You'll be flipping my flapjacks. Look at this, folks. Okay? That's bottomish activity there. And so when I look at things like this, okay, I think refinancing activity, mortgage activity, in terms of mortgage demand, I think all those are at, let's call it lows or in a bottoming out process as we speak right now. And I'm expecting all that to get better as this year ticks on, and then better in 2024 and obviously in future years when it comes to mortgage demand and refinancing activities. So when you kind of got that into a perspective there, it's kind of attractive to maybe be interested in some of those sorts of stocks. I have no position in Rocket. I might potentially make a position in Rocket. We'll see what happens over time. But I can tell you the activity I'm seeing is a bottom-ish process we have when it comes to mortgage demand and refinancing, okay? What I'm showing you now is my second quarter 2023 possible buys, okay? Does not mean all these stocks I'm going to buy. Some of them I might buy, some of them I might not buy. Some of them they need to go down more for me to buy them. But this is my list, okay? And, we're starting to come up upon the second quarter here in the next week or so. So I want to get my list together, okay? And those are the stocks there. Some of all these stocks represent different things, right? Something like an RH, I need it down a lot more from here. I need more pain in RH if I was to make a position in that. Another 20% down, okay, now we're talking in a company like RH. Nike, I need down more here. Foot Locker's already in my buying range, right? Tesla's getting really, really close. I really like it under 180, but it's really close there, right? Target, it's already in range. Whirlpool's already in range. Palantir's already in range. Amazon's already in range. Anything under 100, gimme when it comes to Amazon, right? Intuit, I need down more. Johnson & Johnson, in range. Disney, in range. Revolve, in range. Meta, in range. Anything under 200, specifically with Meta, I'm like, gimme. Pepsi, I need down more. Bros, I need down more. Cake in range. AMD, I need down a little more in regards to that one, right? And so that's my kind of watch list. That's stocks I could be potentially buying here. There's a lot of opportunities in this market, folks. There's a lot more opportunities than what you're just seeing there. If you think these are the only opportunities in the market, you're sorely mistaken. There's a lot more opportunities in this market, and it just depends on where you're looking. Values and divs, a lot of opportunities out there. And I hope the market goes lower in the short term because these will just be better opportunities. We'll see what happens here. But nonetheless, folks, that's kind of where I'm at in regards to all that. I appreciate everybody joining me as always. If you enjoy my content, you enjoy the channel, you get value out of it, and you want to support the channel, do so on Patreon. That will be linked in the description area down there. You also get to see all the stocks I'm actively buying and selling in my Patreon portfolio through Fidelity Investments. That's access to that once again. That's linked in the description area. If you're looking to apply to join my private stock group, my private wealth group, and learn everything I've learned over the past 15 years of the money game and get access to all that, check out the description area. There'll be an application to apply to join us in there. Much love and have a great day.